Top of the morning to you, and welcome to another episode of Capital Markets Quickie, brought to you by MVP Mind Value Partners. I'm your host, Andrew Sella. As the summer heat intensifies here in Frankfurt, so does the heat on the stock market. From the S&P 500 to the NASDAQ and even DAX, they're unfortunately all in the red zone. But in a surprising turn, 10-year U.S. Treasuries, while the yields, they're celebrating yet another record high and yet another positive week. But let's dive into the heart of this episode, which is China, and the reason why everyone is talking about China. And I'm sure you've heard about it, and let's talk about why. Now let's think back to the beginning of 2023. I'm sure you remember those optimistic predictions about China making a big comeback and so on and so forth. Well, sadly, that's not the story the data's telling. 3 years post-economic lockdown, and instead of a comeback tour, China seems to be facing an encore of economic challenges. From a struggling foreign trade to a volatile yuan and a real estate sector on shaky grounds, things aren't looking pretty good over there. Now, speaking of real estate, here's an interesting figure for you. June 2023 saw property sales in China dipped by a massive 14% compared to the previous year. And considering real estate is a pillar of China's economy, that is a pretty big deal. For perspective, think about how much we depend on real estate in the United States. Now, double that dependence, and that's where China stands, because real estate accounts for 30% of China's GDP. But the troubling news doesn't stop there. I have two more pieces of news for you. And let's start with the youth, the future of any nation. Well, they are facing soaring unemployment rates in China, and other parts of the world, like the Euro area in the United States, are actually showing declining unemployment for the youth and graduates. And one can only ask, does this mean that fresh grads in China, might they be seeking opportunities elsewhere? And that is something that the Chinese government is very worried about. And here's the cherry on this not so sweet cake. The third piece of news that I want to talk to you guys about, and that is deflation. I know, it sounds weird. Everyone's talking about inflation, but in China, we're talking about deflation, because both the CPI, the Consumer Price Index, and the PPI, the Producer Price Index in China, are leaning into deflationary zones. And that is unfortunate, because stepping out of a deflation is a much more difficult task for central banks than reducing inflation. But both tasks seems to be quite difficult, because we still haven't gotten inflation under control out here in Europe and in the United States. But it is a bizarre scenario, especially when you look around, at the rest of the world. Because we're wrestling with rising prices and China is wrestling with deflation. Now, if we could just combine these two things together, we might have a solution. Anyways, all hope isn't lost. The Chinese government is making moves, with the central bank slashing interest rates not once, but actually a few times in a matter of hours just this week. Question is, however, will it make a difference? Yes, only time can tell. So yes, we'll have to wait and see. And we should also remember that China's economic story affects us all. Whether we're directly involved or just bystanders, we do live in a globalized world. So let's hope for a soft landing. Now let's take a minute to zoom out and see how the global markets performed last week. Let's start off with Germany, because I do live in Germany out here in Frankfurt. Let's start off with the DAX 40, which is the German leading index. The weekly performance wasn't too pretty, minus 1.63%. However, the DAX is up 11.86% on the year. The second quarter and now the third quarter haven't been too good, but the DAX was off to a great first quarter. And that's basically what we still see here on the year. This is the third consecutive losing week for the DAX, and let's hope we break that streak next week. Only time will tell. S&P 500 also had a negative week, mainly due to the news coming out of China, minus 2.11%. However, the S&P 500 is up 13.81% on the year. This is also the third consecutive losing week for the S&P 500 and for the NASDAQ, which as well had a negative week of minus 2.22%. And it is up a staggering 34.33% on the year. So for investors in the NASDAQ, yes, it is unfortunate to have a negative week, but this is normal on the stock market. However, investors are happy about the year-to-date performance. Moving down to the Hang Seng, or better said, Hang Seng, we had a very, very bad performance coming out of Hong Kong. Obviously, the bad economic data is the major reason behind this. The weekly performance was at minus 5.89%, and the index is down minus 9.25% on the year. Moving on to Brent crude oil measured in US dollars. We finally had a negative week because before that we had 7 consecutive winning weeks where the oil prices were just going up and up and up, and obviously causing some inflation pressure. Moving down, we see that the US dollar, there is some stability back in the field, and gold is also down, unfortunately, and the explanation for that is actually very plausible. Gold does not seem to be an alternative for a lot of investors. We have a 4-week losing streak as far as gold is concerned, and it is not a good alternative for investors who would rather put their money into treasuries. And that leads me to treasuries because the 10-year US Treasury yield is up 2.4% this week. And these are 5 consecutive weeks in a row where the Treasury yields have gone up. And that is due to inflation pressure and investors looking at higher yields for longer. And last but not least, Bitcoin had a pretty bad week, down 10.18%. However, it is up 59.05% on the year. And that wraps it up for this episode of Capital Markets Quickie, guys. I am very happy to be back, and I look forward to our next episode together. I'll see you then. Have a nice week. Cheerio.